Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bonson's Capital Record, brought to you by National Review, where a couple times a week I want to defend the free society. I want to defend the free enterprise system that has made possible a higher quality of life for billions upon billions of people. I want to defend the optimal conditions for human flourishing that I believe a market economy presents, but I believe can only be sustained if we focus on both the freedom and virtue necessary in society to sustain it. Oftentimes, this podcast, in doing ongoing market commentary, requires me to get into certain current events that are a lot of fun. Oftentimes, it requires me to get into certain public policy subjects that are a lot of fun. And oftentimes, it asks me to get into monetary policy, which is the most fun. I'm sure you agree. But it's funny that even with a topic like monetary policy that is often considered boring or wonkish or academic, that President Trump has a way of making it fun. And today I have to comment or think through a few things that President Trump has recently said about monetary policy. Now, I could do this podcast today in defense of Fed independence. I have spoken before about how I believe it is counterproductive for the president to, first of all, make up a pretextual rationale for firing Chairman Powell, which he most certainly does not have the legal right to do. What the very notion of the president wanting to fire a Fed head because he doesn't like the monetary policy we're seeing, what that means for market credibility, for market discipline, for ongoing legitimacy for the US dollar, the US bond market, et cetera. But the fact of the matter is, the president has not fired Chairman Powell. I don't believe he's going to. And yet, he has stated a few things around what he believes monetary policy and interest rate policy ought to be and ought to look like that I think warrant a couple comments, because it's become increasingly important around the messaging here that regardless of what ends up actually happening, that we not allow some of the things being said to influence how we think about things is critically important as interest rates, their impact on economic growth, their impact on proper functioning of a market economy. I want you to listen here to President Trump's real-life Oval Office comments on what he thinks Chairman Powell, who he's obviously very critical of, should be doing right now with the Fed funds rate.
It's something you sort of have or you don't have. They don't. The job he's done is just terrible. He ought to raise interest rates. You know, we should be at 1%. We should be leading the world. Instead, we're paying 4%. And if you look at what that means, that's over $1 trillion in interest that we have to pay. That with the striking of a pen, we would be saving more than $1 trillion. Is that right, Scott?
Yes,
Do you have anything to say about it?
So he would like interest rates to be at 1% or less. And the reason being that just by striking a pen, we could save $1 trillion in interest. So my question is, does this make sense to you? That we would want the Fed to move interest rates down from currently somewhere around 4% to 1%, just because it would lower the cost of servicing U.S. debt. Now, first of all, while I disagree with what the president has said here emphatically, and while I disagree with the president's attempt to kind of muddy the notion of Fed independence and to politicize the central bank further than it is already inherently politicized, I am in agreement with the president that Chairman Powell should be cutting rates. I do believe that the Fed is wrong to hold rates where they are, given the lack of inflationary pressures combined with the tightening posture the current Fed funds rate has, and what that does with a lag effect to certain elements in the economy I'd be more concerned about. That the housing market is inevitably going to bleed into the real economy. And I believe a more natural rate is warranted right now for a plethora of reasons in macroeconomic data. A natural rate is one of these words that someone like me can use because it is not really definable. A neutral rate that is neither tightening nor trying to loosen or accommodate monetary policy. So again, if one says the 4.25 that we're at now is too high, and then something like 2.5 or 3 would end up being a better rate, then fine. But again, I also philosophically, while I recognize that I fully expect the Fed to be the one setting the short-term borrowing rate that banks use to borrow money overnight that then becomes a reference rate for all sorts of other lending, while I fully expect the Fed to be in charge of that for the rest of my life, I don't fundamentally believe in the Fed setting the cost of capital, period. I don't fundamentally believe that we need a central bank to do that. I defend the existence of a central bank as a lender of last resort, but the Fed using and basically price fixing the price of money as a monetary policy tool, I think is first of all highly distortive, highly interventionist, but unnecessary unless you believe a borrower and a lender cannot set the price of money themselves. Because I believe a buyer and seller can set the price of all goods and services, I have yet to hear an argument for why borrowers and lenders cannot set the price of money themselves. And therefore, I don't agree with the Fed's needing to use the interest rate tool as a tool of affecting monetary policy. But I'm not going to win that battle anytime soon. So therefore, I focus on favoring a rules-based policy, and that could be a subject of an additional podcast. But right now, I just want to point something out that I think is absolutely important. When the president says we could save $1 trillion a year in interest if they just lowered the rate to 1%. Well, you know what else could save $1 trillion in interest? Borrowing less money, spending less money that goes into deficit spending. If we want to balance the budget and not have to add trillions of dollars a year to the trillions of dollars of debt we have, that too would save a lot of interest expense. What the president is doing is asking the Fed to do what he won't do, the executive branch won't do, what his predecessor, Joe Biden, wouldn't do, what President Obama wouldn't do, what has been a bipartisan issue of people who were constitutionally empowered to do it, which is the executive branch and the legislative branch. If we don't want that high cost of servicing debt, then let's have less debt. And let's go tighten the belt and figure out how to go about doing that. But what he's asking the Fed to do is enable something that they themselves won't do. That because the Congress continues to spend money so recklessly, he's essentially asking the central bank to jimmy the scale so that while we overeat, it doesn't look like we're gaining weight. How in the world is that the policy tool we need here? That we will just simply cheat the system by lying about the debt level. Now you could say, hold on, it's not exactly cheating the system because they would legitimately be holding the price of capital down. First of all, the Fed can only set the rate on the overnight borrowing. They cannot set the rate on the 10-year, the 30-year. We have plenty of our borrowing termed out over longer term durations that are not affected by the Fed, and that in fact could very well go higher if the Fed did something like that, because of the fact that it would speak to the need to lock in a borrowing cost now because of this intervention and distortion that the Fed would be creating. But second of all, what is the limiting principle? If the purpose of monetary policy is for the Fed to enable a low cost of capital of government borrowing, why not go to zero? Or by the way, why? Because we went to zero for most of the 15 years after the financial crisis. and it invited all sorts of distortions. But if that's what we want to do, why not go to negative yields? You say, well, what are negative yields? That doesn't make sense. The global bond market had $15 trillion trading in negative yields for years, as recently as 2018 to 2022. The idea that the rate is supposed to be something that is set to enable government borrowing is antithetical to sound money. It is antithetical to responsible monetary policy. But then you say, well, David, what is the cost? This is the issue that the president is completely missing. When you artificially hold the rate down to 1% or 0% as he would like, and he says, well, we'd be leading the world. Why should other countries have a lower cost than us? It's a race to the bottom. You are hurting your own currency relative to others, and you are distorting the allocation of resources. An entrepreneur who says, okay, what a bank ought to be charging me to borrow money is this, based on their own risk reward proposition in terms of market forces making a determination. But by artificially holding the rate lower, now I'm incentivized to not borrow money to produce new goods and services, but to leverage up goods and services that already exist. Go buy an asset that already exists, and at a 1% borrowing cost, put a lot of leverage on it. I get the return I need, and I don't take the risk of producing new goods and services. The president cannot avoid this harsh reality that artificially lowering interest rates misallocates capital. Sometimes natural forces may have lower rates than other times. If growth expectations were much higher, then you may want a higher borrowing cost. But basically, left to our own devices, the cost of borrowing money risk-free, which is governmental borrowing, in our case as the people buying bonds were the governmental lender, is going to track the structural growth of the economy, what we'd refer to as nominal GDP growth. So if you believe the economy is going to grow at 4% a year for 10 years, and you're going to lend the money risk-free to the government for 10 years, you'd like to get that cost, the opportunity cost back. You could have presumably gotten 4% by just being invested in something else relative to economic growth over 10 years. What you're doing when you say, let's have the rate at 1%, a significant discount to our expectations for nominal GDP growth, is you now have distorted and frankly perverted what people would be doing with their lending, with their borrowing, with their investing, and it creates malinvestment. This is basic economics 101, and unfortunately, it makes the president's problem worse, not better, because this malinvestment puts downward pressure on economic growth. We misallocate capital. We miss out on the investment that is necessary to drive greater productivity, which then drives greater economic growth, which then creates a higher tax base, helpful to bring down the government's annual borrowing cost. If you want to bring down the cost of government borrowing, besides cutting spending, you need more economic growth. Artificially constricting the interest rate hurts economic growth. So what the president wants to do is a politically driven manipulation to ask the Fed to over-medicate the economy so that it will enable more government borrowing and spending. And it doesn't even work in the end because it distorts economic growth and productivity, which is the real need of the hour. I've gone on too long here. I hope you get my point. It's understandable why the president would like to see Jerome Powell lower interest rates a bit. I agree with that assessment that rates are too high unnecessarily. But when the president says we should just be at 1% because other countries are lower, there's no limiting principle, and it's devoid of the reality of economic trade-offs. There are trade-offs to saying, oh, we're going to get a lower borrowing cost that'll help the government spend less in borrowing. What it would do is distort economic growth, distort rational economic decision-making, hurt economic calculation, productivity, and growth. And that, my friends, would hurt the human flourishing that we are after here in the Capital Record podcast. Thank you for listening to David Bahnsen's Capital Record. Reach out anytime with questions. We'll see you in a couple of days.